Hi, everybody. It's good to be with you today. My name is Berg. I'm from Prudential, and it's great to be with you. I'm going to be covering a financial professional's guide to the changing tax environment. And I think that, as Brandon mentioned, the excitement here is around what's ahead for the industry. What's ahead for the life insurance industry, but also what's ahead for the financial services industry. And by way of background, when you think about what we face every morning when we wake up to a world where $68 trillion is in motion. And much of that money should be in motion towards life insurance as the ultimate wealth transfer tool for a number of different reasons that we'll discuss today, and also you'll discuss in later sessions throughout the meeting. So with that, let's just jump right in. We've got a risk of higher taxes here, and that risk is very great, okay? We have a situation where we have a new president inaugurated yesterday. We have a new Congress sworn in yesterday with a 50-50 Senate. Of course, Vice President Harris breaks all ties on legislation. And we have a House controlled by the Democrats. So we have a situation where the risk of higher taxes is very real. That brings into play the importance of tax efficient investing and planning implications and opportunities that we'll discuss today. But I think that there are some other drivers driving the risk of higher taxes. And when you look at the budget deficits that we're running, 2019, our budget deficit was $984 billion. In 2020, the budget deficit could be as high as we end the year and look back at it as $3.7 trillion. We don't have the final number, but it's going to be in that range. And when we look at the spending that's happening, we have budget deficits and pressure on our fisc like we've really rarely seen. And this is understandable, right? Given the situation that we're in a situation where we're trying to offset the COVID risks and really do what we need to do to keep the economy moving and going. I'm not making any judgments politically. I'm just saying what we're facing an era of high spending. So what that does is it puts tremendous pressure on the fisc, especially when you think about the percentages of all federal spending that are mandatory and are already accounted for and already allocated towards Social Security, Medicare, welfare programs, et cetera, and so forth. Only 30% is really discretionary spending. So we're kind of on autopilot, and then we're adding a lot of spending right now. And what that leads to, in terms of cause and effect in tax policy is, in many cases, higher taxes. Now, we know that we'll have higher taxes after 2025 is over. So 2026, the current Trump tax cuts expire, but we could have changes long before that because really you see how much of our tax revenue is going towards entitlements already. You see the trajectory that we're on. We just have a lot of pressure from a debt entitlement spending perspective, as well as a tax policy perspective. And that's what I'm going to cover next. And I know that we really wanted to drill down on this today and have this discussion about President Biden now. It's not President-elect after yesterday. It's President Biden's tax proposal. So a lot of you have seen this information. But what I want to do is really get practical with you and what this means for life insurance planning and planning in general. Now, you'll see that we have the proposal. It's been written about in many, many different publications that he would like to increase income taxes and payroll taxes on taxpayers with incomes above $400,000. And really what that means is changing that income tax rate from the 37% rate to the 39.6% rate. Now, again, I'm going to go into a lot of this in a lot of different slides. Let's just cut to it, everyone. If we have higher income taxes, especially on high income paying individuals, we need to think about ways to shelter more of that money. What's one of the best ways to do that? Well, it's to purchase cash value life insurance, right? And of course, we have to have a death benefit need. That's always paramount. But let's face it, most people are going to be interested not only in the death benefit for their families, which is income tax free, and that's always an important point and the most important point, but also sheltering money inside that policy on a tax deferred basis, tax preferred withdrawals and loans. We know that story. That story is going to become more and more important, especially if this risk of higher taxes materializes and actually does become, in fact, a higher tax situation. Also, along with that, he's talking about capping the benefits of certain deductions that we can still take if we're itemizing at 28%. So think about what that means. That means if I'm paying tax on the dollar or the $100 or the $1,000 or the $100,000 at a 39.6% rate, let's just say, but my deduction is only at the 28%, that's an effective tax of about 11.6% on even that amount that I'm deducting from my taxes. So again, it pushes these tax liabilities higher. It causes us to be in a situation where we want to think about tax timing. We want to think about how to shelter money from tax, how to turn money on and off out of taxable tax deferred investments, out of tax preferred types of vehicles like life insurance, and even manage it in the taxable bucket as well. So I think that this is really important, especially when you think about the elimination of the step up in basis. Now, Brandon and I were talking about this yesterday when we were preparing for this. And how likely is it? I don't know. I don't know how likely any of this is. There's a risk of it, though. He ran on this. And eliminating the step up in basis would be a huge game changer, right? I mean, when you think about it, what does that mean? That means that if I bought a stock at $10 and it's $100, I've got $90 worth of gain in there, right? Well, if I eliminate the step up in basis, usually I'd get a step up in basis. If I die with it being valued at $100, the new basis is $100, right? If I sell it right away at $100 a share, I don't have any capital gain. But if they eliminate that step up in basis, I've got $90 worth of gain in there. Now, we all know what that means, and everybody that we work with in finance knows what that means. Our clients have to really come to terms with this and say, wow, if they would eliminate the step up in basis and either A, impose the tax right away on death and just say, well, you're going to be taxed on capital gains taxes on $90 right then and there, right? Or B, when you sell it, when the beneficiary would sell that stock, you would incur capital gains of maybe $90, maybe even more than $90 or less than $90, depending upon when you sell it. It really complicates life. And what we need is we need more liquidity. We need more insurance. We need more cash to help us either with that immediate liability, if that's the way the law is written, or with being flexible in how we sell going forward on that capital asset. So I think that's very important. A corollary of that is that President Biden is even talking about not only just eliminating the step up in basis, but also taxing capital gains at ordinary income tax rates for those earning above $1 million a year. Now, think about what this means, everyone. If we have ordinary income tax rates applicable to gains for people that are earning above $1 million, long-term capital gain property is going to become more expensive to own, right? So what should people be thinking about right now? They should be thinking about maybe harvesting some long-term capital gains right now, right? Maybe looking at their portfolios and taking that profit now at those lower rates. And hopefully, if these changes go through, they're not retroactive. If they're retroactive, that's a different story. But the bottom line is that they need to make some decisions. What am I going to do right now, especially in situations where I have high gain positions in my portfolio in long-term capital gains assets? Am I going to harvest some of those? Am I going to, leave it as it is? They need to be making decisions now. Also, a planning point with respect to the cap deductions. If you're going to do some charitable deductions, better probably to make them early in the year before the new law is enforced. Again, if it's retroactive, then it may negate the effect of all of that. We don't know what's going to happen, but the bottom line is that people need to take a look at their situations and decide what they are going to do, right? We don't know what they're going to do and write the law, but we know that people can look at their situations and say, what are they prepared to do? What do they want to do? Especially as we get into more of these proposals. There's a proposal to raise the corporate tax rate to 28% and implement a 15% corporate minimum tax. Importantly, on our side of the fence, on the life insurance side of planning, we have this issue of maybe reducing the exemption amount, which is right now at $11.7 million per person, down to $3.5 million or $5 million, and expand the Social Security taxable wage base to include income above $400,000. So that's an increase in the payroll tax. So again, risk of taxes going up. You can see some of the proposals in terms of the new brackets that would exist. And by the way, everyone, we're going a little bit fast through a lot of tax information and a lot of these grids and charts. I want you to know that these slides will be available to you through Algren, and you're going to get these from Brandon. So you can read these at your leisure and really dig deep into what it means bracket by bracket. Bottom line is you can see that the taxes will, if these are passed, go up for most people. And again, we want to mitigate that risk by making moves in the portfolio, in the products that we're using, in being more tax diverse to really manage these situations no matter what happens for people. And you can see on the left-hand side here on the capital gains tax, I've got what it is today versus what it would be under a Biden plan if it were passed into law. So at least what we know about the Biden plan so far, right? All those caveats apply. Again, you can see that the taxes really go up as you hit that $1 million threshold. So think of your clients that are really high income. They really should be doing a lot of income tax planning right now, not just estate tax planning. Also, you can see that, we have the standard deductions that are in place right now. That's what the law is currently. But also many people itemize still. And in itemized deductions, we still have a lot of people itemizing their mortgage interest deduction, their charitable giving deduction. We have a limit on the state and local income taxes for now. A lot of people itemize their medical expenses. But again, what Biden wants to do is cap the tax benefit of these at a lower level than what the income tax is. And I gave you the example earlier about how that creates another tax, and reinstate the PEAS limitations. Those are some old limitations that also further limit the value of deductions. And the good news is it looks like he would like to have the SALT cap, the cap on the state and local income tax deduction, removed. So that may offer some relief. Again, we don't know what he's going to do, but we want to make plans for our clients based upon their situation, about what they should be doing, about how it benefits them, their families, how they keep more and leave less to the government, right? So minimizing what the government has, maximizing what the family has, or maximizing what they're giving to their community. That's what typical planning involves, and certainly what we focus on every day. So when we do that, and we're educating people on the income tax side, we want to always start with reviewing their whole portfolio for tax efficiency. And right here, we're talking about income tax efficiency, right? So we're not going to spend a whole lot of time on this today, on every single bullet point here, but all of you are well familiar with the fact that there are high turnover ratios in mutual funds. It really impacts your average after-tax return. It can create pass-through gains. And, the tax impact of that really depends upon the holding period of the investments and so forth and so on. But it can cause a tax drag on that portfolio. It can cause a tax on that asset, just like costs can create a drag on the performance of assets. And so what we want to do is make their portfolio more efficient, yes, and their investment advisors are doing that. And to the extent you have that investment advisory business within your own practice, you're doing that. You're trying to help mitigate the effects of these turnover ratios. And you can see the average turnover ratio in a mutual fund, for example, or a tax bond mutual fund are right there. And that creates pass-through gains. So you could have a down year, maybe not last year because the market was really good, but you could have a down year and still have more taxes. And that's the point. So, higher turnover ratios and short-term capital gains can really combine to create a very negative tax environment for somebody. So, if we have these high turnover ratios and we have basically long-term capital gains, or what were thought to be long-term capital gains turned into short-term capital gains, we have an even worse situation from a tax perspective. And that's the point of this slide. So again, the overall point is we want to reduce tax costs, tax drag. We do that in a number of different ways. It can be very significant in terms of what that means for a person, depending upon their facts and circumstances. But we have a number of different ways that we do that. The way into that conversation, we found these questions to be helpful. Please incorporate them in your practice to the extent they're helpful to you. What I like to do is ask somebody, a lot of my friends or a lot of the people I work with or a lot of the really successful people I work with are really subject to high taxes. They think taxes might go up. Is that something that you face? How efficient are your investments? Do you have any high turnover mutual funds? Are you getting statements where you have gains, but maybe your position was overall down? Are you paying taxes when you rebalance? Are you paying taxes on income you're currently not spending, right? And I think a lot of times the answer to that question is going to be yes, right? So how do you want to make your plan better? How do you want to make your situation better? How do you want to make your product portfolio better? How do you want to make it more efficient? How do you want to diversify so that you mitigate against these risks, so you minimize the problems that you're facing? That's really what life insurance selling in terms of the cash value piece is all about, because what we want to do is introduce them to the benefits of tax efficient investing. And we know this, but our clients, they're focused on keeping their jobs, keeping their business open, maximizing their profits. Are they really dialed into, especially what life insurance can do, right? They know about their other investments. They know that they can have ETFs and all kinds of, tax efficient investing in the taxable account space. They may know about annuities and what those do. But how about life insurance? How about life insurance's ability to control tax timing, to provide additional tax diversification that they may not have thought of, to provide for tax bracket management, going to be so important, always important, but so important if that risk of higher taxes actually materializes and goes up. Reduce the tax on Social Security if they're concerned about that, and maybe even reduce their Medicare premiums, right? If they're subject to higher Medicare premiums because of a higher AGI. All of these things come into play depending upon their facts and circumstances. All of them are income tax planning oriented versus estate tax planning oriented. And here's really the slide that I want to focus on, which is really diversifying their retirement income strategy. When we think about how we build a client's portfolio, we're really thinking about, how we accumulate assets. And that's what we've done for a long time. We're beginning now, and we have begun over the past 10, 20 years to really think about retirement income. How are we dividing up the assets into taxable accounts, which is really the today money, what they're probably going to use today, or maybe go on vacations when they can start going on vacation again after COVID. What's tax deferred? What's longer term? What are they looking to for the future, for future income sources? And then at the bottom there, that's where we focus. What's tax free? And it's more than just life insurance. Okay, it's muni bonds, it's Roth IRAs, but cash value life insurance is what's overlooked the most. Here are the tax benefits of life insurance, and this has been a very popular slide with us. And again, we're not focusing on estate taxes here. We're just focusing on income taxes. 101A of the code provides that death benefit tax-free. 7702 and 7702A, we're not going to talk about that a whole lot on this presentation because you're going to have a whole presentation on that later. But that really relates to the definition of life insurance, how much money you can put in. And as Brandon said, in many cases, we're going to see a situation where potentially anyway, you're going to be able to put more money into life insurance and still have it qualify as life insurance or perhaps not trigger a MEC limit. These are very, very important points for us. And then, of course, Section 72 is where we get the code authority for those tax-free policy withdrawals to basis from a non-MEC policy. And 101G is very important because that provides for the ability to pay out a portion of the death benefit tax-free for chronic illness. So again, a lot of people say, life insurance just seems too good to be true. Why should I pay attention to this? What really is the bottom line here, Brett? Why is this? It's because the tax code provides for these benefits. They want people to buy life insurance. That's what this says to me. Okay. And I think that any tax expert would agree with that these incentives are put there, just like any other incentive in the tax code, to get people to purchase more life insurance. We want people to purchase it because it is a great product for wealth transfer. It's not the only thing that you can do to create tax-free income. You can have Roth conversions. I have a slide in here on that just for the purpose of being complete. And you can have muni bonds. You can do a lot of different things. But life insurance is the most overlooked. And you can see that the historical, tax rates that we've had over time have been really historically high. We're in a low tax rate environment right now, right? Currently. And, something that Doug and I have talked about over the years is that really over time, over the past 10 years, maybe even over the past 15, 20 years, as people have been putting money into their life insurance, their cash value plans, that has been the smart thing to do. Because really, when you think about it, when you're in a low tax rate environment, you should be doing more things after tax so that later on, when you're in a higher tax environment, you can tax time. So again, the opportunity's been there for a long, long time. The people that have been doing it, very smart move. Still opportunities to do that right now. We're still in a low tax rate environment until things change, and they will after 2025 at a minimum, and perhaps sooner, depending upon what Congress and the president can get passed in the meantime. And similarly, estate planning has changed a lot too over time. Estate planning, used to be that you could only give away money, to basically at the first death. Then they came up with the unlimited medical deduction. Then they've increased this exemption amount or the applicable exclusion amount or the credit, over time. And you can see what it has been. And you can see we're at a great time for people to gift. And that's something that we've been talking about for a long time. We talked about it all last year. We saw it happen a lot. And it's still an opportunity for people to gift away a lot of money without paying a huge estate tax bill on it. We see that here. This is really the slide that you need to keep in mind when you think about the rule here. The top rate on estates is still 40%. The exemption amount is $11.7 million per person. Double that for married couples. Gift tax is unified, and you can see that you can also give away an annual exclusion for present interest gifts. I would be taking advantage of that gifting opportunity now if they have not already done so. I would at least take a look at it and really evaluate every estate that is above, say, 25 million bucks for this opportunity, certainly over 50 million. It's important to documents too. And I'm not going to spend a whole lot of time on this today, but these attorneys that you're working with, they should be reviewing the wills and the formula provisions that they put into their documents, because you can see that just based upon one little provision here on the left-hand side, the Smith Family Trust shall be funded with an amount equal to the applicable exclusion amount. The remaining amount shall pass to my spouse. Depending on the year on the right-hand side, that's going to create different results. In 2008, the applicable exclusion amount was $2 million, so the wife would have received $3 million outright. Now, the wife receives $0 outright. Now, look, the wife could still benefit from that trust, maybe get income from that trust, or maybe some principal. That's really beside the point. The point is that what John wants to have happen? Is that what his wife wants to have happen? Have they reviewed their documents? Have they made their plan better? Have they really modernized their plan? It may be time to do that. It's really the perfect time to do that. It's the right time to do that. You can see how changing circumstances really change the exposures for people. That's what this example is going to do. Robert and Diane, $10 million in net worth, their current exemption amount is $23.4 million. They don't have any problems right now. But let's just assume that their estate grows by 5% and we have just the expiration of the so-called Trump tax cuts. We'll see what happens, right? They're not exposed to the estate tax right now, but just with the growth in their estate and the reduction of the exemption amount under current law, nothing that Biden has to do or the Congress has to do has anything to do with the results that are on this screen. I'm just 5% growth and a reduction in the estate tax exemption under current law. You can see their exposures getting more and more out into the future, 2026 and beyond. Their estate tax exposure is there in red, just based upon very conservative assumptions. Not to mention state estate and inheritance taxes. To the extent you have state and inheritance taxes applicable, that's another cost that we have to factor in for life insurance exposure for protection purposes. Have people protected themselves as well as they can? In most cases, the answer is no, right? And I'm sure many of you work with clients every day where this is the case. Many of you working with other advisors where this is the case. Certainly, I've seen it as the case. I had a case just the other Friday of last week. $100 million person, no estate plan whatsoever. Exposure of it, upwards of 50 million or dollars in tax if you take into account inflation and at a given rate of assumption, moderate rate of assumption on the estate, and you take into account the reduction of the exemption level, and no estate plan whatsoever, no will, no insurance. Why? Because that person was focused on becoming successful, as they are, and they are. That person is successful, but they need to protect themselves. They need to modernize their plan. They need to make sure a plan is in place, just having a plan. And part of it is, we talk about life insurance, but just by gifting people make their situation better. It reduces the estate dollar for dollar. It removes future appreciation from the estate. It leaves more to the family and less to the IRS. That's the point. It preserves family business. You can leverage it up with life insurance, and it is a great benefit. A lot of people say, well, if I give away money now, will Congress try to claw it back later? They've said no. They've said no, and that's the Treasury Department ruling and document that gives you that authority to say that. Again, everybody's case is going to be different. Maybe the attorneys don't want to do it. Maybe the client doesn't want to do it. Maybe they want to do it differently. Maybe they may want to do a loan. Maybe they want to do a number of different things. The bottom line is we have to say to them, do you want to take advantage of your gifting opportunity now? Do you want to take a look at your situation now and say, what can I do to make my plan better? Let's maybe take advantage of an opportunity that may not be there much longer. Certainly after 2025, it won't be. And not Congress, the Treasury Department has said they won't try to change the rules after you've done it. They will not try to claw back that gift after the exemption goes back down to what it was before the Tax Cuts and Jobs Act, the so-called Trump tax cuts. So let's see what that means. John and Lucy, married, 61. They've got a $45 million net worth. They've got exposure right now. They want to leverage a gift. Just by getting that gift out of their estate, they remove that $10 million for dollar outside their estate, and they remove all appreciation on it. So what you're looking at here in this slide, as it goes up to 27 million over 20 years, is just the gift that they made with the accumulation at 5%, right? Now, we've got an example in here, and every example is going to be different, and we have all kinds of issues nowadays with our products in terms of how much premium we can take, not take. What you have is a great resource in Algren to help you figure out what you can do and not do in each situation. This is just for conceptual purposes to show you what a fixed death benefit on a leverage gift could be in a scenario like this. You could take $10 million and make it, 51. I'm not saying that that's going to work out in every case, or that the premium funding is going to work out in every case, or with every company. What I'm going to say to you is that everybody needs to do their own analysis on their particular case. Algren can help you do that and really figure out what the options are across the board. There are really powerful reasons to do that, right? Not just the number that I just showed you, but the protection that it provides. When we talk about life insurance, we talk about internal rates of return, and I'm sure you've heard this from many people that you work with in the industry. The internal rates of return are very high on life insurance, especially early, and the tax equivalent rates of return are high very early, because they should be. Life insurance is there to protect you against the risk of dying too soon, of something happening prematurely. It should be high, but even at later years, it's very competitive. So we've talked about the benefits of life insurance for leverage gifting. I'm going to, that's really a repeat of what we said before. Again, you've got lots of tax benefits of life insurance. And then, of course, if it's in an irrevocable life insurance trust, it's removed from the estate for estate tax purposes, creates even more tax benefit. Here's some other things that happen to people as they go throughout their life. When one spouse dies, upon the death of the first spouse, the income goes down, but taxable income can go up. That's the point of this slide. So I'm not just saying that we need to do life insurance planning just for the ultra wealthy. What about the widow whose pay goes down, but income taxes go up? How is he or she going to deal with that? Do they have the liquidity to deal with that? Just the death benefit of life insurance would help there. Also, a popular sales program and planning program that we've had over the past year, it really gained steam until about March of last year. Then COVID hit, and then all of a sudden, people aren't talking about this. This is still very real for most people. For many people, this is actually a more real problem than the estate tax problem that I talked about. Because estate taxes only apply to about 0.1% of the population. How many people have IRAs that you know? A lot of people. The stretch IRA is gone for most people. That's the point of this slide. What does that mean? That means that what you could do before, where Don and Kathy, age 65, you can see $1.5 million in their IRA, $1 million in investment assets, a defined benefit pension. Great client, right? $500,000 of money earmarked for their daughter. It used to be that you could stretch that out over time. For those of you who knows Ed Slott, have seen Ed Slott present or others present, or from our company present. We talk about this all the time. You can't stretch the IRA anymore in most cases. There are exceptions. They were listed on the previous slide, but in most cases, people are going to have to take a lump sum distribution. Look at the difference there. Look at the difference. If I'm going to stretch it to 1.8 million versus net to the beneficiary, if I take it 1 year, of 458,000. It'd be a little bit more if I stretched it out over 10 years, because I have 10 years now if I'm a non-spouse beneficiary in most cases to take the money. So I wouldn't have to liquidate it all at once, but a lot of people do, and it's quite a difference. It's a stark difference of benefits to them. So what do we talk about? We talk about repositioning a part of that IRA asset over to survivorship life insurance in this case. And it could be trust owned. It may just be owned by Don and Kathy, or it may be owned by Don and passed to his irrevocable trust. There's lots of different ways to do this. Bottom line is that what I'm trying to do is provide them with more money, right, in a more tax efficient way. So here I reposition $20,000 of the IRA every year, or it could be another asset, to the survivorship life, and I provide them with more money than if they just left the money in the IRA. In scenario one, because he's taking some minimum distributions and things of that nature, Don, and then he leaves that money to his non-spouse beneficiary, his child. There's income tax on that. We're going to assume a liquidation at death, $458,000. If he just would have repositioned a little bit of that IRA every year, like I described in that previous slide, he has less money in the IRA, which reduces the income taxes, right? And more money in the tax-free death benefit, leading to a difference of $1.3 million in this type of situation. I want to leave a little bit of time for questions. So I'm going to go through this really quickly too, but this is a very important point. Okay. For any of you who have listened to any IRA expert, and this could be Ed Slott, it could be many, many people, and it could be Natalie Choate, right? Natalie Choate is one of the experts in this field as well. But IRA trusts were a big, big planning tool back in the day. I talked about them a lot. And what I would do is I would say, look, you just leave your IRA to a trust. The oldest beneficiary of the trust will be the measuring life, and you can stretch the payments out to the trust and then pass through to the beneficiary. Or sometimes you would accumulate it. Look, these trusts are a ticking tax bomb, okay? Because the trusts in most cases have to take the money in 10 years, within 10 years too. And that accelerates the income, it accelerates the tax. It increases the tax depending upon the situation, because trusts are taxed at the highest marginal rate after very, very little income. So these if I was in private practice or in personal production, what I would do is I would ask every attorney, every client, everybody I was talking to, do you have an IRA, what are you going to do with it? How are you feeling about it? You don't want to take money from it right now. I know, nobody likes taxes. Hey, do you have something called an IRA trust, or is your IRA payable to a trust? If so, you really should take a look at that, because that may create some unnecessary, unexpected tax consequences. Maybe we can make your plan better, right? Because again, as I mentioned, the trust taxation, the trust income taxation is very high after $12,950. It goes to the highest marginal rate. You certainly don't want the money trapped in that trust and creating a huge, even a bigger tax bill than it would if it was payable to a human beneficiary over 10 years. So with that, I'm going to summarize, then I'm going to open up for questions and discussion. In summary, we're in a time, $68 trillion passing, right? From generation to generation over the next 25 years. And where do I get that? That's not in the presentation. That's from Cerilli & Associates. And it's been quoted in many, many different places, Wall Street Journal, other places. You can look that number up, $68 trillion. And, we are investing in a challenging income tax environment, but we're also transferring wealth in a challenging income tax environment. Investment decisions, any planning decision, have tax consequences that are not normally considered, and especially in life insurance planning, where people are missing out, just missing out on the tax diversification that they can take advantage of, using life insurance as the ultimate vehicle to not only provide an income tax-free, and in some cases an estate tax-free death benefit if it's properly structured, but also provide important income tax benefits to them. And so again, just highly underutilized. Never been more excited about the life insurance industry than I am right now. Never more optimistic than I am right now. I've been in this business on this side of the business, in the industry, for 25 years. I was a lawyer prior to that in private practice. Never been more excited about what your opportunity is to get life insurance integrated for your clients in the right way and make their plans better. So with that, I'm going to turn it back over to you, Brandon.
All right. Thank you so much, Brett. Really appreciate it. A lot of stuff, I'm sure, as everybody saw. So the first question we have, can you discuss pros and cons of using survivorship insurance versus a Roth conversion on those IRAs?
Well, let's just talk conceptually. Okay. Roth conversion, to my way of thinking, is about people who need the money for retirement. Okay. So let's just talk about needs, because that I'd have to do all the mathematical analysis and, crossover points and all kinds of stuff to really think of if it's mathematically better, depending upon the assumptions. But just kind of cutting to the heart of it. Who's the money for? Who is the money for? If the money is for them in retirement, maybe Roth conversion is going to be a better situation for them, right? Because they're going to have the money in an income tax-free environment. It's income tax-free to the kids. They can use it for their expenses in retirement. If they're never going to use it, if it's never money, then you're getting a lot of leverage on that. Just think about the example that I gave you. $20,000 turns into year one, 1.4 million, right? In addition to what's left in the IRA, right? So you could mix and match your strategies too. So I know that doesn't answer it's difficult to answer a question like that in a blanket sense, because it's going to depend upon the facts and mathematics of each situation. But in my way of thinking, I just try to break it down. Who's the money for? Then it's very easy for me. I think if they're healthy, right, if they're insurable, if we're going to get good ratings, then the survivorship life is
right now. I don't see another question just yet, but I think something we were discussing yesterday, and I think you touched on it briefly, but stressing the amount of scrutiny that each proposal has to go through, and whether or not it has to go through reconciliation or whether it has to be approved by a majority. Could you touch on that a little bit? Because I think that's a very important point to touch on.
Yeah. So that goes to the likelihood of this all happening. Let's just sort of break that down really quick, because there's even more. It's even more complicated. We've got a 50-50 Senate right now, right? So they're just having discussions, let's just put it that way, on how they're going to bring anything to the floor of the Senate, right? And they have to agree on a bunch of rules. Yes, the Democrats do have control because, at least on passage of a bill, because Vice President Harris is the tiebreaker. But they have to just agree amongst themselves on how to bring bills to the floor. Then, to your point, Brandon, then to pass bills, right? Usually you need to have more than 60 to break that filibuster. Still a rule in effect, unless they get rid of it. That's another thing that could happen. But the bottom line is, if the filibuster is still in effect, you need 60, unless you're going through a process called budget reconciliation, where you could pass it with 50+1. So lots of things in play here. Also, I would just mention this. Taxes tend to be very divisive. It doesn't really matter which side of the political realm we're on. Nobody likes taxes, right? Or very few people do. And if you do or you don't, taxes tend to be divisive. What has President Biden been emphasizing so far? Unity. Also, COVID relief is top of mind right now. So are we going to get it right away? I don't know. But I would say this. I think the risk of the bill getting introduced and the risk of the bill passing in some way, shape, or form by the end of the year is there, because he ran on it, and they're going to want to get something done this year versus wait until next year when they have a midterm. So that's the conventional wisdom of most of the people that we talk to in Washington, our lobbyists, the people that talk to these lawmakers every day. And so we'll see.
That's the key. Policy is one thing, politics is the other. So just so everybody knows, Steve asked in the chat, and I'm sure others are wondering, we will be hosting the slides. Brett has allowed us, I think Prudential's okay with us hosting this. Not only the slides, but we will be hosting the recording for as many of these sessions as the carriers allow us. Do we have any other questions? We've got 1 or 2 more minutes. If we do get another question, I will get to that. But just so everybody knows, from here up until our last keynote speaker, we will be in the sessions tab. So as you see to the left right now, we are live on the stage. In about 3 minutes, the sessions will go live. And when you go over there and click there, you'll see the different sessions that are coming up. It makes it easier if you ask the in the chat for the session. Ginger just asked, any talk about HSAs? Ginger,
I wonder in what regard she's asking. Yeah, look, I think this on the healthcare side of things. I haven't focused on the HSA question, but I can envision a scenario where we would have talk about HSAs, right? Because of the very real issues that we have with healthcare in America, saving for healthcare in America. So I don't know if that's the nature of your question. I don't know. I don't have anything specific on HSAs. to cover for you
quick
today.
clarification is
But I would not be
using using them as an investment account for long-term healthcare costs later on. So I don't know. I've had.
I have not seen anything specifically on that.
If there are any other questions, please feel free to ask. Otherwise, we've got about a minute until our sessions will open. And Brett, as always, a pleasure having you. You're a trove of information, and really appreciate it.
Well, we appreciate your business. We, to the extent Prudential can be helpful to you, we look forward to doing that. And just again, to reemphasize, I just think that most people just are not taking advantage of their life insurance opportunities to modernize their plan. So we look forward to helping you do that.